This wasn't just a good business, this must be a really good business to keep trying to create growth. What if something comes out of left field? That's why we're constantly trying to check that. Is it P-cell that comes up? Is it mesh networks? I was on the road last couple of weeks before earnings, and I got asked the drone question numerous times. What if somebody deploys a drone network in the United States? All of what the military is going to do in battlefield situations. And could you see drones replacing cell sites? So we constantly see that because the technology side of this equation, the people supplying the apps and seeing all those gigabytes and petabytes and new names we keep making up for the amount of data we consume, are looking at this also trying to figure out how they can deploy it. So I think as an industry, that's probably the number one thing we probably need to be aware of is we know what we know, there's some things we don't know. And to constantly look outside and say, if we just look inside the circle, I wouldn't have thought, okay, people could look at our cycles and understand this whole cycle we have is tiny, whereas other cycles are big. So that's, I think, my biggest concern is, what if I miss something? What if there's something so left field I don't say it today?
Phil, from your perspective? All right, thank you for a lot.
Just great conversations.
Okay.
Nothing down.
I'll take his place.
Excellent. I know you're not asking Marco, right? Actually, wait. There you go, absolutely.
I think our biggest threat to our business is ourselves. I think when we think through the cycles of this industry, when we think about the good times and the bad times, I think we always think about the preservation of the business model, first and foremost. And so when we start charting off into territories that remind us of times in the past, I think we need to be reflective of that, and we need to be cognizant. I think there's new thematics that we see today, that some of these things are resonant today, and some are things that are a product of the past. I think we've never seen, Clayton, with this much abundance of capital in this sector, ever. The inflows into this space have never been better than they are today. And that's across all parts of the investment spectrum. Whether you're public or you're private, there's a massive amount of potential inflow into the sector. So as custodians of that capital, we have to be we have to be good custodians of other people's capital. I think when we think about where this business was like 10 years ago versus today, some of the things that we see today is we now see that our customers are more educated, and they're asking us for more. And we've seen this if you've looked at the public filings, you've seen some of the recent MLAs that have been done on major tower transactions. You begin to see massive amounts of reserve loading on towers. Reserve loading that is the equivalent of 1.5 to 2 tenancies of occupancy. This has been one of the great things about our business, is that we can count on our customers to reinvest in the sites and increase cash flows. We see our customers asking for lower escalators. That inhibits growth. We see M&A multiples on private transactions for the first time trading more than 30 times. 30 times, right? To think about that, you got to go back to Steve Clark's Spectre site days for AirTouch. And those are not good bellwethers. Because I think what's always been great about this industry is that, we've always been a pretty disciplined group of folks. And so I think that is something that we have to think a lot about, is, as Jay said, how do we allocate capital? How do we wake up every day? How do we make capital allocation decisions? And are those capital allocation decisions, they're based, as Brendan said, they're based on growth assumptions. And to make certain entry prices work, you have to have embedded in that model a certain set of growth assumptions that are going to yield certain returns for your investors. And each of us have very different return expectations for our investors. But today, this marketplace feels a bit frothy today. And I think I haven't felt that kind of sort of frothiness since the late 90s, to be honest, in terms of particularly where M&A multiples are traded. You really got to look at transaction comps. You got to wind back the clocks over 16 years ago to see where we are today.
So why is that? We've had a whole day of meetings already in our private room back there. Came up every meeting, multiples are high right now. What's driving the behavior to push the multiples up? Is it assumptions of what the growth rate's going to look like? The spread really does uncork its middle plan. What's driving multiples up? I'll hit that.
Quantum, we do a lot of transactions, so we see a lot of these multiples in the 30s and whatnot. Generally, the 30s is going to be a single tenant tower, new tower. built to suit, right in the ground, so there's one tenant. One more tenant, that multiple gets bought down with 1763 back. Will get a second tenant, so that's the 30s. There are no stupid men in this market. None of these men that I've had the wonderful opportunity to work with for the last 18 years, they're all really smart. I think the real answer is we don't know, and I think most of us are pretty impressed that we've come this far. As crazy as it sounds, for the last 5 years I've been very negative. I've been, can't go any higher, can't go any higher, can't go any higher. And it does. Feels like my dad was a physician. He'd come home every year. I think our payer sources are done, but they never were, and they're still okay, even though doctors complain about that all the time. So again, a lot of smart men. The values you see, I guarantee you there's a reason why one of these guys is paying what he's paying, okay? Other than that, then we'll just, anyway, that's my opinion.
Well, good. That's probably a good transition to the next two topics. Carrier build-out is certainly a lot of people are bullish on just the future of CapEx deployment into the carrier networks, but then also upcoming auction as well. So those next two topics. Rick, I'd love to get your quick coverage on what you're seeing as far as leasing advancement with the carriers.
Yeah, sure. It's been echoed throughout today's meeting so far. AT&T, obviously, this time last year, people were saying, best leasing environment I've ever seen, things are amazing, things are great. Then all of a sudden June hit, and AT&T hit the brakes because they were spending like a drunken sailor, it seemed. And finance guys kind of caught up and said, we can't keep spending at this run rate, we won't have anything left. So it was too much. So they pulled back. The tone of this session so far, our meetings today, have been the hope that AT&T can only pause for so long. They've got to keep spending on their network. It feels like people are thinking that the apps come in third quarter, fourth quarter, and maybe we'll see them come back to the table. Maybe, certainly, probably not back to the first half of the team levels, but better than where they've been. Verizon, I think any year, any meeting, you hear the word steady Eddie come out when you talk about Verizon. Very good network planners, people that are, when I told us earlier today, they're meeting with the region. They're already working on their 17 plan at Verizon. Those guys are really meticulous, well thought out spenders of capital. T-Mobile picking up the pace we talked about them today on the conference call. Their effort to get 700 megabit deployment. They're doing it. They have to do it. They will improve their network quality. Sure, the T-Mobile was great this quarter. 1.3, I think that's one of the headlines coming out of the T-Mobile quarter. Who would have thought a company like T-Mobile could get sub 6%? 2 years ago, when T-Mobile was 2.5, people thought maybe someday you can get it to 1.7. They're already at 1.3, and that's not a lot of low band spectrum, which they're actually building up right now. Wildcard, talked game changer, Brendan, about Dish. And personally, I'd say Sprint would be a game changer. They've been nowhere. Man, we had people say they hadn't seen squat from Sprint for 1, 2, 4 years, name the number. It's a long time since Sprint's done anything meaningful. And all the buzz is building that they get it. Saying you cut your rate in half won't get you a customer if the network doesn't work. You've got to have a good network. You've got to have a network that people can believe in, and a network that can deliver the goods. And so the buzz really right now is our little prep sheet says Sprint has announced it. No, they haven't announced it yet. They will have their earnings call next week. And I think we're all with bated breath as a tower industry waiting to hear what Sprint's really going to do. Is it real this time? Feels like it is. What's the timeline to do it? Do they have money? No. They're out there with a tin cup trying to find money from vendors and other people, but they know they need to get it built. So I think that's the wild card. Verizon steady, AT&T slow, probably comes back. We keep hearing from people, T-Mobile's a more active builder than people probably would have thought, and Sprint's really the wild card.
Mark, anything you got on that one?
No, not much. I mean, we've heard about anecdotally coming out of Kansas City, somewhere around 8,000 search rings, but that's been the buzz for everyone shaking heads like this. It's been the buzz when I'm shaking heads. That's been the buzz for about 6 months now. One of the more interesting things was whether or not after that 8,000 sort of search ring deployment, were they going to go with this sort of 40,000 to 65,000 core small cell strategy that we heard, commencing with 20,000 small cells in 4 major cities. That was interesting because that's sort of following the playbook that worked for SoftBank in Japan. So, I'm of the Rick ilk here, which is it's not a function of, will it come, it's a function of when it comes. Some of those rings are on the street already. But we're just waiting for the magic launch codes to come from Japan to unlock the CapEx. I think we heard pretty resoundingly from our friends at T-Mobile today, down. Hopefully they're saving some for the fourth quarter. We heard Dave Mayo this morning, he wants us to be nicer and pay less rent. I don't know if that's going to happen, Dave, sorry. But we'd certainly like to see T-Mobile reinvest in the network, because that, while drips and drabs come out, and they're doing some of the roaming overbuild, 1,700 sites is not enough for everyone to go around in the room. I think AT&T will be back. I think that they feel like they've satiated their CapEx spend for the year, but we've heard that before, and usually that comes with a full quarter surprise. It's typically what happens. So Verizon's been fantastic. They've been very steady. And in our U.S. REIT, Verizon makes up 40% of our backlog right now. So thank God for Verizon. They're very steady, very consistent, and they're doing everything. They're adding more gear to the towers in terms of microwave. They're doing de novo new builds. They're doing densification network. They're very aggressive on small cell right now. Crown's been a huge benefactor of that. So at least we have one customer that's going really hard right now.
So that's utilizing the current spectrum holdings. We touched on the incentive auction coming up next year. The current administration seems pretty set on getting it launched. Kevin, your firm does a lot of work in spectrum, as does ours. What are you seeing or hearing out as far as the carriers, what they're looking for, how the upcoming auction may impact their current thoughts on utilizing their current spectrum, maybe what their initial thoughts are going to be, if they are participating in the auction, and utilize that as well.
I hope I don't have to answer all those questions, but I'll just briefly, thank you for asking me before Rick, because I wouldn't have anything to say afterwards. Rick, you're next, because I know you're on the spectrum. I think the biggest part about the incentive auctions, the carriers have to heal their balance sheets. There's $44 billion and sub $41 billion when you take out the discounts for the EWS3. That's a lot of capex that goes into that, and we hope that when they're healed, then they go build out that EWS3. You get into the incentives, and it's a very complicated process, as everybody knows. It's a reverse flip forward. I think broadcasters, we all believe that they're not going to just roll over and get their spectrum up. And the thought is, right now, 600 is a phenomenal piece of spectrum. It would be excellent for everybody, so I think that's going to be very profitable. Probably raise close to $60 billion, then you have to build that out. And I think the biggest challenge then is how do you build that out once you have spent so much from your balance sheet acquiring that spectrum. So it's going to take longer, and that's what I think this year.
Great. Thank you on that one. We'll turn to a couple of the panelists who have spoken here. We're going to go to the middle market tower company topic. Middle market tower companies typically, as I define, maybe 100 up to 1,000-ish towers. It's always been a big component of the tower industry as far as companies developing towers on a local level, doing selective acquisitions, et cetera. From your perspective, David, first turn to you and then over to Ron, because I know, Ron, you're excited to talk. What do you see as far as opportunities for more scale in the next 2 to 3 years? What are some of your challenges and your goals?
First of all, not to be here once tower companies own 40,000, 60,000 towers. So Insight looks at this as a need scale and how to find scale in the mid-market platform. You've got to find opportunities, so you dig deeper. You dig on the onesies, twosies, you build towers, you do the smaller transactions, you look for capital that hopefully will get you to the same sort of competitive rates so I can play in the same marketplace as the larger companies. So at Insight, we have done that with a focus on domestic towers in the U.S., but we also have a platform for gas and small cell. We have a platform for land under towers. So we have deployed our capital in what we think is the most accretive fashion. And so in sort of managing our equity side as well as our debt side, we also look for a strategic partner. We're able to secure that with Fox Communications. So we think we have a unique platform. We're small, but we're well over 1,000 towers, we're about 1,200 towers today.
At Tarpon, we take a rather different approach. Scale for us, we don't believe is necessarily important. I think the business is mature to a point where, from a maintenance and operation perspective, there's plenty of folks out there to give you the economy scale that you need to take care of the assets. Each asset is a franchise unto itself and supports itself. It's protected by zoning. So as we look at buying towers, and we're buying really 1 or 2 at a time, it's difficult. Indeed, with the likes of the guys sitting on the right and left, we're looking for just the best either through our own efforts or working with local developers.
Yeah, I think the middle market, you heard two different views. I think there are benefits to scale. I think one of the things that we were able to achieve at GTP is we got to scale and we got to very, very, very free cash flow positive. And once we were able to get there, we were able to return capital back to LPs as a private restructure. And that was an important technical for us as it related to our LPs. Today we've gone and done that again, and we're a private REIT, and it's, the most important thing is starting in the tower company, whether you're the small guy or you're a market guy, is you've got to grow into your cost structure. And so, a minimum size management team with the appropriate infrastructure to buy assets and to build assets, your sort of minimum check getting the door is about $2.5 to $3 million of SG&A. So that means you've got to get to a point where you can not only pay for your SG&A, but you've got to pay for your debt service, and you've got to get to a point of free cash flow. So we've always thought about, scale was a number where you have to get to sort of minimum 15 to 20 million of operating cash flow. You can pay your bills, pay your debt service, and then be able to reinvest cash. Because the great thing about the business is you move sort of year 5 and out. As a private operator, you can start really getting the benefits of that free cash flow. And then you can wake up and start making capital allocation decisions the same way that the three public guys do. You wake up and say, okay, how do I put this money to work? Do I return capital to my investors? Do I build new towers? Do I buy new towers? And that's really where you begin to feel the impact of scale. And it takes time. And I think there's not a magical number in terms of tower count, but there certainly is a magical number in terms of free cash flow. And that's how we thought about it at Vertical Bridge.
So one further change, over the last 15 years in the mid-market tower space, we now see mid-market companies that want to go longer and able to go longer. The capital structure permits us to have a more competitive, longer-term horizon, which makes us a lot more competitive for the long-term decisions. So we have deployments of capital early on, we can wait 3 to 5 to 7 years to lease up, whereas in the early days, we have a 5-year window and a lot of pressure for those types of private equity investors to sort of exit.
Yeah, that's right. I think, and also when you think about Clayton, some of the private equity guys that are writing $20 to $25 million checks, and the guys that build 15 to 20 towers, that's a tough road to plow. And I think, some of the smaller venture funds that are writing those $10 to $15 million, $25 million checks are finding it's really difficult to get the returns they want unless they're rescued by Johnny Bolton.
Clayton, I like that on that. That's an interesting point, Mark, because when we sold our last batch of towers in October, we really didn't want to sell. We were private equity, back, and the private equity was need to return back to their LPs. So they wanted to exit. So they wanted to sell the assets. Frankly, we had probably 80 towers or so that were really on a 10 basis, 110, on a BB basis, 1.310 equivalent. And when we went out this next time to raise capital, we didn't want to be in that position again. So we looked at bigger capital sources like infra funds and sovereign, but we're just too small, and our strategy is a little different than indicated. So we found a family office, which is fit new, I think, for guys of our size. And these guys have, what I've heard you say before, Mark, a permanent sort of capital source. They're not really interested in exiting the business per se over time, like private equity would be. So I think if you're a small guy out there, that the traditional means of raising capital from private equity is really not an option anymore for a couple of reasons. First of all, the long-term hold period that you do need. And second of all, you can't even begin to become competitive with the likes of David Young, and certainly not the public and Bush Marshall.
That's a good point. I think that, we look at how our investors have changed in the last few decades. And this industry was predominantly financed in the 90s by private equity or venture-backed financing. And then you moved into the 2000s and you saw the predominance of these sort of major buyout shops owning big pieces of tower companies. And I think the next trend in our industry is really going to be sourcing capital direct from what Ron's talking about. Family offices, endowments, pension funds, and pension funds are incredibly sophisticated. They have big direct invest programs. And they have another problem, which is they have an inflow problem, which is a lot of these big pension plans, particularly in places like Holland and Canada, there's more money coming into the pension system than it's going out. And so when we look across some of our new shareholders, for example, we have the State of California Teachers Retirement System, and their view on that capital is it's 20-year capital. that's, as Ron said, that's the way to compete. If you have 20-year capital, you can really take a conservative approach. You can be patient. You can take a risk, more risk perhaps, on building that tower in that great location than worrying about the fact that you've got to look for the exit in 5, 7, or 9 years. So I think that the sources of capital are changing in this industry, and I think that's good, because I think for us to sustain ourselves as an industry, we're going to have to attract a lower cost of capital. And that's really going to come in the form of insurance companies, pension funds, family endowments, and these types of investors.
Thanks. Switching over to international towers as a topic, specifically to Brendan and Ron. There's been a lot of activity internationally, specifically in Latin America, that makes a lot of headlines, also in Africa. How does the U.S. compare with international markets in terms of leasing demand, expected returns, major drivers as far as leasing international markets, and as you look to expand internationally, what are some of the factors you would look at? I'll put this one first. It's hard to compare anything to the U.S. and say that we've got, because obviously the U.S. has been just a tremendous tower market. We've all benefited from that. And I think as we look at international today, the deals that we're looking at now internationally versus deals that we look at here in the U.S., we do expect better returns versus what we could achieve here in the U.S. on average. And the reason for that really is at the core of what the carriers are doing and where they are in these markets that we're in. They're at least 5 years, maybe more, behind the U.S. in terms of the wireless development cycle. So we see a tremendous runway ahead in terms of leasing activity in many of our markets that we're currently in. SBA is primarily internationally in Central America and Brazil today. In those markets, 3G is fairly new. It's not even built out, and a lot of spending that we're seeing is coming from 3G overlays and development, as well as just flat-out coverage builds that are taking place. 4G is even that much more limited. And so when we look at what's happening here in the U.S., it's kind of a prototype for what we would expect in the markets that we've experienced internationally. We think the growth is going to be tremendous and sustaining for a lengthy period of time over the coming years. And as a result, our expectation is through the lower cost of some of these assets and the long growth profile that we'll see better returns on some of these new investments internationally than we've seen here in the U.S. It's really just it's an extension of our growth cycle as an organization as a whole. And that's really about the money. Ron?
So for American Tower, we're in 12 different countries, or 5 continents, so we've been pretty aggressive in terms of our international investments. And the first thing I'll address is the evaluation criteria that we look at for every market we go into. And it's really a triage approach. So first we assess the country level activity at the country level risk. We then go on to assess the industry level risk, the industry within that country. And then we look at the asset level risk there. So when we look at the country, we certainly look for a country with a large population, growing economy. We want to make sure it's politically stable and has some good evidence and support for rule of law, particularly real estate law. So those are all critical for us in every one of the countries that we